Hello everyone. Today we are looking at a balanced scorecard project. First the theoretical preparation and then the execution with examples in Power BI. Our example for today is a company in New Hampshire where they have 96 Linux admins and consultants that are hired out to other companies that have problems, questions about Linux admin. And these 96 are led by two managers who are the owners at the same time. Basically, the idea of the balanced scorecard was to have reports that do not center only on finance, but also many other things that go on around it, like sales, customer satisfaction, business development, processes, and so on. So it would be not just one-sided financial, it would be a balanced scorecard. One of the basic ideas is that there are non-financial factors that contribute to the success of the business. Like customer satisfaction of today makes it more likely that I will have revenue tomorrow. It's not a guarantee, but it supports that. Well-trained and motivated employees contribute to satisfied customers. Not a guarantee, a contribution. Well-trained and competent leadership contributes to good business decisions. That of course means that you also need data which you cannot only get from accounting. You will have to go into other departments and maybe even start recording data that you haven't recorded before. Then some people took a next step and developed the balanced scorecard into a strategic tool. The first step is to determine what does our business stand for? What is our mission, our vision, what is our purpose as a business? What values, what products and services do we provide to our audience? Then we look at that purpose from 4 to 6 different perspectives. It's mostly either 4 or 5. Some businesses do 6 perspectives. We formulate temporary goals from those perspectives. From there, we define KPIs, key performance indicators, to measure A, do we get the results that we want, and B, are the actions that are supposed to lead to the results are actually taken. So you can measure either the achievement of goals or the pursuit of the goals. In this process, quite a few things can go wrong. The vision or the purpose of the company may be misunderstood. Customer needs may be misunderstood. I have seen a billion-dollar company go completely broke because they misunderstood customer needs. They said, oh, this is something that we can provide easily and that we enjoy providing, so we'll provide that. Problem was the customers didn't care about that at all. Not at all. So within 2 years they went broke. What some people call visions may also be ego navel-gazing or delusional. In fact, I have 2 great quotes about visions. One of my favorite heroes, a former German chancellor named Helmut Schmidt, said, "Life is practical. If we have visions, go see a doctor." And there's another man who has a pretty good grip on a lot of things, named Dr. John DeMartini. And he said, well, vision is fine, but if you're expecting more pleasure than pain from your vision, it's not the vision, it's a fantasy. Also, you may define goals which you think will help the company, but they may not necessarily do that. For example, you may think everybody should know our brand, but your audience is not everybody. Your audience may be a lot smaller, and then you spend a lot of money and effort on becoming known by everybody. That might not make sense. The KPI might be poorly chosen. For example, you've probably heard the term taking massive action. So there is a time and a place for massive action, and there's sometimes a direction for massive action. But if you take massive action in the wrong direction, it might not help you, it might even hurt you. Like, I've seen companies where they count the number of calls that the sales team makes. And if they're not reaching a certain number, they get sanctioned. So that means the ones who only make the calls that actually make sense get sanctioned, while the other ones who call everybody and annoy everybody and hurt the business get rewarded. It can also happen that there are measuring errors with the KPI, so they may get poorly recorded. I remember the oil used for trucks. Some poor young guy in the repair shop was told, whenever you make an oil change, you enter it here. They did not tell him you also have to enter the truck number for which you are making the oil change. So we had one truck with a few hundred oil changes and 199 trucks without. Also, KPI may be poorly interpreted. The most stupid way to interpret a KPI is to say KPI bad, employee bad. I've seen examples where the sales team got blamed for lesser sales in ice cream and grilling coal when there just hadn't been sunshine for a while. There was an unusually bad weather period in that region, and of course people didn't buy that much ice cream and grill coal. But who got blamed for the weather? The sales team. That is not smart. This company has decided to choose 4 categories, 4 different perspectives: finances, customers, employees, and business development. These 4 perspectives are very standard. Some businesses add different perspectives, like a supplier perspective to optimize the purchasing and use of materials, or yet other perspectives, but these 4 are pretty basic and are very often used. First perspective, finances. There are many standard KPI from this perspective. This company has concentrated on the most important ones, like solvency, the ability to pay short-term liabilities. Then margin 1, which is revenue minus direct cost. Then profit. They want a positive earnings before taxes of at least $150,000 per year for each owner. Contributing to the revenue, of course, the main factor in this business are billable hours. So they want each employed admin or consultant to work at least 135 billable hours per month. And then they want an operating profit margin of at least 8%. These ones are fairly easy KPI. They are widely understood by most people who work at a certain level in business. They are easily calculated. You have standard formulas, and they're not very complex and easily verifiable if the accounting is correct. And this one you get all from the accounting department. On the customer's perspective, the first goal is that customers should be on average satisfied to at least a degree of 7.5 out of 10. That's not aiming super high. That sounds realistic to me. Of course, the customer satisfaction needs to be properly and accurately recorded, so they probably have some feedback process where they get a call after the project, or they get interviewed by the consultants themselves, which it can be a little bit tricky because sometimes people are shy to give a negative review when the person is right in front of them. So you need something in place to prevent that, to mitigate that. Second goal is that customers should be repeat customers. So at least a quarter of the customers should later come back for more. Since this is a service business that offers a service that is usually needed more than once, that is a reasonable goal in this case. From the employee's perspective, the first thing the company wants is a balanced age structure. But you see, this is not precisely defined. They definitely want employees from all age groups, so in their 20s, in their 30s, 40s, 50s, and 60s, 70s maybe not. But there's no exact KPI defined. They want to make a histogram, so the distribution of age groups should be shown in the histogram, but it's not exactly defined here what a balanced age structure is. I think it is sort of common sense that you have peoples in their 20s, 30s, and 40s for the most. Then sometimes it's good to have some experienced people in their 50s and early 60s, and on the 70s, depending on the person. But probably if 80% of your employees are over 70, depending on what you are offering, might become a problem. The employees are supposed to be trained in customer orientation. Well, how well they understand the training and how well they apply it is a different matter, but you can measure whether they have received the training or not. And whether or not they are applying it well, you will later see in the results, or you will not see it. Employees should be content working at the company. Also, they should have a rating of at least 7.5 out of 10 on average. And this gets measured every 6 months. So yeah, this is relatively easy to measure. You measure what they reply. It can be better to do that anonymously. In this case, it's done where the employees reveal who they are and what their rating is. So it has advantages and disadvantages to do it that way. On the business development level, the main project is that the two owners and main managers receive training in leadership of bigger organizations. So they are leading over 90 people. Therefore, they need some skills that most people are not born with. They have decided to be assessed also by supervisors, preferably the ones who train them, and to consider their assessment together with their own assessment. Say their self-assessment counts for 1 quarter and the supervisor assessment accounts for 75%. And if they are not too far apart, that might be a healthy way of doing it. It might also be a better idea to only take the supervisor assessment. There are different opinions out on that. And this, as we will later see in the numbers, is something that might take a while. It's not like I go to a leadership seminar for a weekend and then I become a great leader. So this can take quite a while to really understand the lessons and use them in real life and real life business. Let's go over to Power BI, and here we have the finances perspective. Goal achievement can very well be reported in gauge visuals. Not I don't do it always, but it's one good visual to show goal achievement. So with a quick ratio, you see it's very close to the target value in March 2021. When you click through the time, sometimes it goes below the target value, but it usually doesn't stay under it for long. So it's usually, in most months, it's over it, and in a few months it's under that value. Sometimes the quick ratio is very high, but when you have this size of business, the amounts can vary a lot from month to month. So this is to be expected that there will be great variations in that. When it comes to the billable hours, you want at least 135 per month as a target average.
And well, these guys work a lot. Usually work around 180 hours a month on average. Gets more overtime, so yeah, they're pretty close to the goal. The margin 1 is very often way over 15%. It's under that. Is it ever under that? I'm not sure. Think it's always above that target value. And I like to do a funnel visual with revenue to profit. So revenue, COGS, salaries, consultants, both direct costs leads to margin 1. Then operating expenses subtracted from that get us the profit earnings before taxes. And they want at least 8%. I think it's below that just twice. And then it's usually way above that. So pretty good goal achievement on the finances perspective. In the customer's perspective, we have customer satisfaction and repeat buys. I did not do it as a gauge this time. We have a target of 7.5 on average, and actually it is higher almost all the time, I believe. Yeah, hardly even goes under 8. So good job they're doing. We have the most satisfied customers, the least satisfied customers, and even with the least satisfied ones, it almost never goes lower than 5. I think it goes down to 4 a few times. And then we have a count of customer ratings for each month. So we want to know how many rate us from 8 to 10. That's quite a lot. And below that doesn't happen very much. Here we have the count of buys, and it's always calibrated to the day of reporting. See, this customer bought 32 times, 31 times, 30 times. And I've also added the date they first bought as a reference. Of course, the later ones with the higher numbers, they made their first buy later and they haven't had too much time to come back yet. But they tend to come back quite a lot, obviously. So also here we have very solid goal overachievement. Third, we have the employee's perspective. I thought in this case a time slicer wouldn't make too much sense. This is also calibrated to the day of reporting. First, we want the age distribution. We have a histogram here. So we have 4 people in their 20s. And as we can see in the details here, they're all 29. We have 51 people in their 30s. We have 30 people in their 40s, 6 people in their 50s, and 7 people in their 60s. Oldest employee is 68. Yeah, but that's not too many in that age range. Employee satisfaction, there's another histogram about the distribution. So 19 out of 98 people are super satisfied. 18 are quite satisfied. 11 are still very satisfied. 16 are pretty okay. And then it goes, yeah, the lower ones, we do not have any false 3s and 1s. Again, it might be different if the questionnaire was anonymous. So that might be something to explore for the future. And out of 98 employees, 82 have received customer orientation training. Last not least, we have the business development perspective, for which the management has basically chosen one KPI, which is the development of leadership skills. We have a timeline and we can see it takes quite a while for them to ramp it up. So Yeah, Miss Ventimiglia is ahead of Mr. John here. And you see, until they go up from an average in the 6 range to an average in the 8 and 9 range, that takes 5 years. These measurements are taken, the assessments are taken every 3 months. And then what they self-assess is weighted at 25%, and what the supervisor assesses is weighted at 75%. And it takes a while to ramp it up, because leadership is a skill and a personality thing. And sometimes I may not improve as much as I think I do. Also, good leadership is very supportive of good business. Of course, it's not a guarantee, because if you're selling something that no customer is interested in, then good leadership doesn't help you. But they've already established they have a service that many customers are interested in. So leadership will help them, but not necessarily immediately. Because we have seen in the finance perspective that the revenue has not significantly gone up in the same time they've been training leadership. So either the market is saturated and they can't do much better, or it just takes more time for that to take effect. One question with these things is, how much explanation do you add to the visuals? And that, of course, depends on the recipients of the reports. Reports are, if they're meant to be useful, are designed in cooperation with the people who later receive them. And in this case, it's 2 leading managers, the 2 owners, who also lead and manage the business. So they understand the balanced scorecard pretty well. They worked it out together. They worked out the goals and the KPIs, so they will understand what is being reported here. If this was a more complex thing with more recipients on different levels, I would add a lot more explanation. But for those 2 people, that's most likely enough, because they have designed these reports and they are IT people, so they will also understand how this stuff is calculated and how it works. They probably also know the DAX language, but at least they will understand this. So no long explanations needed.
One thing you hear a lot about is cutting cost. Well, as a smart consultant said, any idiot can cut cost. The art is in cutting costs in a way that does not lose you long-term revenue. One thing that is often underestimated is the effort that it takes to really improve customer satisfaction, that it takes to really improve employee satisfaction, that it takes to truly develop better leadership skills. This can take a long time, and this can feel like a real strain. I've worked on things for years sometimes until they took effect, until people noticed an improvement. So this can take a very long time, and the temptation will sometimes be to just deceive yourself. Just change the measuring of the KPI so you get better results, but the results are not really better. So please consider that really improving relevant factors can take a while and quite some effort. Also, some strategies and some measures take quite a while to take root and grow. So even if you have a better product, more satisfied employees, better leadership, does not guarantee that your business is going to explode next week. These things can go quickly, and sometimes they can take a lot of time. At this point, as usual, have fun, Godspeed, see you next time.
Some new data just came in. They say that the most attractive men of all are controllers and business analysts. I wonder who collected and evaluated these data. Ah, I see. A controller and business analyst from Hamburg, Germany. Possibly he is a little biased.